Welcome back to Floss Law. I want to keep this video series going. Sun's going down on me. We had a really busy day in the office today. A lot of closings going on, less closings than we normally have for the rest of the year. You know, when you get to the end of the year, the closings kind of slow down. Um, but this time of year is still very busy for us because we get a lot of our clients that come in. They want to talk, do conference calls on the phone, and talk about strategy. And when we talk about strategy, we mean looking at what you've done in the past, maybe making some changes, or just setting goals for what you want to do in the future in investing in real estate. Um, you want to look at doing team building and doing things like that as well. We're going to do that in maybe the next video. But right now, today, I want to talk to you because I spent all day working on it. So I figured I'd share it with you guys about formulating your strategy in real estate. It's so important. Um, Step one when you're formulating your strategy is figure out who you want to be. So when a client comes in, they sit down and they look at me and they say, I want to become serious in becoming a real estate investor. I say, well, what kind of investor do you want to be? Where do you see yourself? Do you see yourself as the person who is out finding the deal, finding the property, saying, I think that there's a real opportunity here? Do you see yourself as the person who's going to be the fundraiser? Sometimes people really have a tremendous skill of taking an opportunity, taking a property, and presenting it to someone else and getting them to really want to be involved with that deal. Don't underestimate that role when you're building your team. Sometimes certain people really have a skill of bringing money to the table. It's extremely important. Um, do you see yourself as the person like you see on TV, that's going to the properties? You're picking out the color, the decor, um, maybe changing the layout of the property. Do you see yourself going there and doing that? Are you the contractor? Are you the person that just wants to go in there and do the work? You want to be involved with investing in real estate, with owning your own real estate, but you're a skilled laborer and you want to use that to your own advantage instead of to other people's advantage. Um, Whatever step of the process, whatever you bring to the table, you need to know what role you're going to play going into it. You can't do everything yourself. It's just not possible. So know who you are and know what kind of investor you are going into this, so you can know that okay, this is the piece that I know I bring to the table, and I can maybe also do this other role, but I'm going to need people to do roles C and D. I can't find properties, raise money for properties, fix them up myself, and oversee the other people doing work at the properties, and list it and sell it and do all of it. You're going to have to rely on other people at some point. Um, so where it all starts is knowing who you are. What role are you starting out as? If you don't know what role you have, sometimes we get people that come that want to invest in real estate that don't know a lot about real estate. They don't know what role they play. Sometimes we could take a step either further back and say, okay, well, what experiences do you have? What work experience do you have? What life experience do you have that you bring to the table? And we can kind of figure out how you can be either the team leader or the team player and find your niche, how you're gonna fit into all of that. So it's crucial that you start from there. Once you get that established, then we can move forward as far as figuring out what you're going to go after. That's really step two. Is now we need to figure out. Now you figured out who you are. Either if you're going to be the person finding the deals, or whoever you're going to designate or be part of your team to find the deals. Now we need to start working with that person to figure out what are you trying to find that will accomplish your goals, because there's hundreds of different kinds of properties out there. There really are. You could buy single family home, rent it out. You could buy a single family home and flip it. We all know that from watching TV shows. Condos, townhouses, but then you get into 2 flats, 4 flats, apartment buildings, industrial buildings, commercial buildings, strip shopping centers. A lot of people have had a lot of success the last few years with buying mobile home parks, with buying storage facilities. nursing homes, whatever. There's so many different things that you can invest in. And there's a term we use at this point. We don't want you to get caught up in analysis paralysis. What that means is you consider every type of real estate deal that's out there, and you put the time and the research into evaluating and analyzing every real estate deal that's out there. And you spend so much time doing that, you become completely exhausted. And by the time you have to either put an offer in or move on a property, it's either gone because you've taken too long, or you're just exhausted and you really just don't even get around to it. I've seen people that just don't even respond to the emails, and by the time I follow up and say, what happened with that deal, and they just say, honestly, came home from work, I tried to look at these 30 deals I had in my email, and after a while I just stopped, I just gave up. And I said, well, you probably missed out on an opportunity there. And they say, yeah, I know. So what you really are trying to do is focus in on what deals accomplish what your goals are. Are you looking to, generate money in like a month-to-month basis? Are you really looking to get that big bang that, you get from flipping a house where you get a lot of money from that? Are you looking to establish a long-term wealth where you're looking at more of like a two-flat or an apartment building? Are you looking for something where you could put a ton of money into it and get a huge return off of it? Or maybe putting like a lot of sweat equity into a property, which I guess you could do in any of the properties, but it's different depending on what your goals are with sweat equity. Are you looking to get sweat equity where you go in, do a bunch of work to a house and flip it? Are you looking to buy an apartment building for cheap, do a bunch of sweat equity, do a bunch of work to fix it up, and then you have a building that's performing at an incredibly high rate, and incredibly profitable for you that you could potentially keep forever? A lot of different scenarios there. So when we're meeting with our clients, we're really trying to figure out what was the reason you went into this? What were your goals going into this? Are you trying to establish wealth? Are you trying to make money? And those two aren't the same thing. I mean, you develop money, you make money in different rates. So we really want to know what type of investor you are, and then what your goals are. So we're putting those two things together to help you figure out, okay, well, it sounds like you want to flip houses, or it sounds like you really want to just buy already rented two flats. Because some people come in and they don't want to do any work. They say, I want to start investing for my future, but I don't know anything about doing plumbing. I don't know anything about fixing up a property. I've never met a contractor. So we call that turnkey. So we know we have a turnkey investor. You've come in, you told me, that I hate working with contractors, or I don't know anything about it, and I'm afraid I'm going to get taken advantage of. So now we know that you're going to be a turnkey investor. We need to find you maybe a 2-flat or a 4-flat that's already been fixed up, that is rented out, and you're basically just going to come in and now buy that property and collect the rents. There's nothing wrong with doing that. It's often an overlooked form of investment. Not everyone wants to go in and do rehabs. It doesn't mean anything's wrong. So we get either side of that. We get the turnkey investors, and then obviously we get the contractors or weekend warriors that want to get the worst property they can and put all their money into it and get a huge profit from that going forward. So it's really, we're formulating that strategy. And by narrowing it down, we can narrow down the properties that you're going to consider, because you don't want to get that analysis paralysis. What we want you to do is be able to find properties that fit exactly what you're looking for. And then when something that matches comes up, you can look at it. And a lot of times we get included in that process, because our clients will say, look, we're considering this property. Can you take a look at it and give me your thoughts? And that's part of what we do. We might identify if we think that there's issues with zoning. We might identify that we think that there's issues with building code violations. Because of our prior experience, That's something that we can give feedback to our clients about, because we have to defend our other clients when they get noticed up by the city of Chicago for code violations or for a zoning violation or anything like that. So invariably, we can now offer that to our future clients, and say, I saw this. I see that this is a potential issue. This is something we need to watch out for. So we try to help out with that deal flow to help them analyze properties. Um, it's all part of team building, that you know that you're working with people that are knowledgeable, not just telling you that every deal is the best deal, that are telling you, okay, here's a bunch of bad things about the property, but I still think it's a good deal because of all of these other things, and you're listing everything out and you're weighing it, because no property is perfect. And unfortunately, as part of the attorney, I'm usually the Debbie Downer of the group. I know what my role is, and it's usually trying to make sure that all of my clients are aware of what the difficulties that I've encountered with other clients are with particular properties, making them aware of that, and then saying, if you're good with this, then let's go ahead, let's do it. Sometimes we'll try to check if there's any liens or anything. If we've seen that a property has a history of issues with a village or a municipality with violations or things like that, we'll let our client know. So we want our client to be educated going in, so that they don't have surprises. That's the goal. So you're going to be evaluating properties, and you're really going to narrow down, all right, I want to flip single family houses, or I want turnkey two flats, or hey Bob, I really want to buy an apartment building this year. We get that a lot, where clients will have a few single family home rentals, and then we'll want to make that jump up to, I want a building now. I want a big one that's going to make a lot of money. Includes a lot of risks with it, but also a lot of profit. So it's usually not where you want to start if you're watching this. You're typically not going to start with like a 6-unit apartment building. If you're really serious about becoming an investor, typically, I would say most of my clients have either started out really with a rental condo, just to get started and get their feet wet. A rental single family home is very common. And then if you, depending on where you live, if they have two flats, a lot of people buy two flats. Or what's become incredibly popular, and I wish I would have known this would have been more popular when I was younger and I would have done it. It's called the Burr method. I'm going to go do a whole nother video about that, and you can read about it online. But it essentially says that if you're young, that instead of buying the property you're going to live in first, that's going to lower your debt to income ratio. We'll do a video on finance. We'll talk about all that. But just know, debt to income ratio affects how you get mortgages, how you get loans. If your first property is the property you live in, then your debt goes way up and your income goes way down as far as that ratio is concerned. If you're renting, your income's way up here, your debt's way down here, hopefully. And once you buy your first house, then that evens out, because now your debt's here and your income's here. It's a ratio. The Burr method says that your first property should not be the property that you live in if you see yourself trying to become an investor building long-term wealth. This method says that you should buy like a 2 or 3 flat as your first property, renting out the other 2 units and you living in one of the units. By doing so, instead of your debt to income going from here to here, now your debt to income goes really from here, maybe even potentially to here, because you're now getting all the income from the property. You've added the debt, but you've added income at the same time. So you've kept that ratio. Hopefully it might come closer, it might go far away, depending on the property that you bought. By doing that, it makes it way, way easier for you to turn around and get, maybe in a couple years, another mortgage to buy another investment property, and then buy another investment property a couple years after that. So essentially you're living in this property for nothing, because the 1 or 2 tenants should be offsetting almost all of your mortgage. You're saving up your money for another down payment. Once you have enough for another down payment, go get pre-approved, buy another building. Now you're getting only income from that property. You're going to have a mortgage on it, but you're not living there, so you're going to get way more income coming in. And then you just keep repeating that process, and it snowballs. Keep taking that income, saving the money from your job, get another down payment built up, buy your next property, so on. And then wait until you get to like property 5 or 6, and then go buy, the house or the condo that you really always wanted. But by making that initial sacrifice, you really have set yourself up down the road. So if you're young, maybe if you're newlywed or not married and don't have kids, look at doing that. Honestly, if I would have known that, 10 years ago, I would have done it, but I didn't. So definitely something to consider. So when I'm sitting with my client, I generally tell them you want to have about the 20-minute rule. My 20-minute rule is you want to be able to look at a property, consider it, analyze it, and make a decision in about 20 minutes. If it takes you longer than that to do it, then you really need to back up and figure out how you're analyzing your deals, because it shouldn't really take more than that. You should be able to look at the property. Either you or someone on your team should be able to eyeball the amount of work it needs, and either you or someone on your team should be able to run comps and say, okay, this is what it's worth now, this is what it could be worth when it's fixed up. And you take all those numbers and you put them together. It's called backing out the deal, and I'm really excited to do that one because I love doing that. You're backing out the deal. You're going to take how much it's worth fixed up. You're going to subtract out the closing costs, which I supply. You just ask me and I tell you. So I'll say, here's your closing costs, estimated closing costs based on this price. You take how much you're going to have to put into the property, so you're going to use your best guesstimate of how much work it's going to take. And you need someone that kind of knows that, because if you don't, you're just throwing out numbers, then you can really find yourself in a situation where you've underbid yourself and now you're in a bad spot. So you need someone that's pretty reliable on contractor numbers, so you can figure that out. And then work your way back, closing costs when you're buying it, and figure out what you can pay for it, and see if what you can pay for it and what it's worth or what it's on the market for are close to each other. Sometimes both those numbers are way off from each other. The asking price is nowhere near what you'd be willing to pay for it, and you flag the property, keep an eye on it, and you move on. I mean, you could try giving them a little bit offer, but a lot of times the numbers aren't close together. If once in a while you get a property where the numbers are close together, you put in an offer and see if you can make something happen. But you need to be able to do that pretty quick, because again, you don't want the analysis paralysis. You want to be able to look at this property in about 20 minutes, be able to kind of put together the rough numbers, take a look at it, put it in your spreadsheet. You want to put together some kind of spreadsheet so you have all the information to look at, so you can just input the numbers and you're not recreating this every time. You can put the numbers in your spreadsheet, see if it works, and then if it doesn't, just email the person back that sent it to you, or if you just found it yourself, just say, just throw it out, or email back the person who sent it to you and say, the numbers just don't work here. Let me know if they lower the price, or however you decide to answer them. But you need to be able to do that quickly. If part of the 20-minute rule is you're putting yourself in a position to respond almost immediately too. So if someone sends you a really good real estate deal that fits your niche, you can respond that day. You can run those numbers and get back to them, that night, and say, this doesn't fit because of A, B, C, D, which also can help. If the agent's sending it to you, can help, because now they can give feedback to their sellers. Or you could say, this is a great deal, I want to jump on it. And really, part of this is you want to put yourself in a position to be able to jump on deals, because a lot of the really good real estate deals, especially in a lot of parts of the country, and I'm in Chicago here, and depending on what niche you're in certain pockets, certain areas, the good ones go real fast. So you need to be able to move on them incredibly quickly. You can't wait and get back to them a week later. It's gone. It's not there anymore. The really good deals, the really good flips and things like that, they're gone almost immediately. So you got to be able to jump on those fast. And part of that is being able to analyze quickly. Sorry, I'm just looking at my notes here, guys. I want to make notes because I want to make sure I got everything in that from my client meetings today, really. Narrow down your area. We talked about property. We didn't talk about area. So you're going to want to have, as part of it, as narrowing it down, you're going to want to have what your area is going to be. Um, if you're doing a rehab, you probably don't want to have a property that's too far away from you unless you really have someone that you trust more than anything, that's going to be like your project manager or whoever's going to be on site every day. Because when you're doing a rehab, you need to be on site at least every 2 or 3 days. You can't leave people unattended in your house. Not saying they're going to do anything bad, but if you're not there to give them directions, they're just going to start doing what they think should be done in the house, and that might not be what you wanted done in the house. So you might show up and be really angry about what they did, and the guy's going to be looking at you like, well, you weren't here. So we needed to do, what we thought, we could do under the circumstances. We couldn't get a hold of you. So someone needs to be available to be there and say, this color goes on that wall, or this is what we're doing with the bathroom, or here's the plan, or here's this goes over here. Don't throw that out. We need that, or whatever the situation may be. Someone's got to be available for that. So don't start buying rehabs in any old area. You want to kind of confine your area to places that you have access to, or someone that you trust has access to. I've seen people execute really good rehabs from long distance, but they knew someone that they could call and say, hey, there's an emergency. Can you get over there? And the person was able to get over there. So you don't want to just pick them in any random spot. Area becomes a very big deal when you're talking about long-term rentals too, because you want to make sure you're buying a property in an area where there's a strong rental pool, and that it's going to maintain that, and that you're not in an area that maybe has a history of poor performance. I have a lot of clients that have a lot of properties, and people have different terms for it. Some people call them war zones, or gang activity areas, or places that just have really poor performance, and they've still made a lot of money. You just need to know that as part of your analysis, that when you're looking at a property, maybe this two flat, if it was in this pocket, would be worth 400,000, but because I know I'm going to have issues with tenants and I'm not going to get quite as much money in this pocket, maybe it's only worth 200,000. It doesn't mean it's a bad deal when it's it's in the other area. A lot of those deals get dismissed, and other people just gobble them up and make a lot of money. You just need to know that you need to buy at a lower price point to factor in, all right, maybe I'm going to have to do an eviction, maybe I'm going to have to do some stuff with the tenants, or whatever the situation may be. You just need to factor that in. So, and obviously there's going to be some blocks where you might not want to buy a property no matter what. I know there's certain blocks that we deal with in the city of Chicago where a lot of the buildings have been torn down. And when you're dealing with a property like that, where maybe you have a two flat that looks really good, but half the buildings on the block have been torn down, and it just looks really bad. Sometimes an investor is going to pass on that no matter what. They're just going to say, this going to be a long time before this area looks good, or this block looks good. But then you might have literally 2 blocks over that looks amazing. You go, well, this pocket looks great. We'll buy one here. So know your areas well. Do your research on your areas. Know if you're close to transportation. A lot of people, unfortunately, I feel got taken advantage of by doing long distance investing, where they didn't know the pockets that they were buying property in. And especially if you're going to invest in Chicago, it's incredibly important to know pockets. Chicago, especially in certain areas, is really block by block, honestly. So you need to know that. And a lot of people, I think, unfortunately, bought properties here from maybe out of the country and didn't realize what they were buying or where they were buying it at, and how tough they're going to have a time getting, that particular property to perform. But there really isn't any area that you can't make money in real estate. You just have to make an educated, informed decision on what you're buying, and make sure you get a good price point on it. And you can make it work. You can make any property work. no matter where you're buying it at. I get some people that buy investment properties in the highest end areas, and I get people that buy investment properties on the very lowest of ends, and both of them make a lot of money. It's just knowing what you're getting into, and it's all part of your strategy. It's knowing that I'm going to target lower end properties, and I have a system for making it work. I know people that live there. I do live there, whatever it is, and you can make it work. Or the very high end that you have the cash to make that work, to buy those really expensive properties, and understand that you need to keep them running at maximum efficiency to keep them really profitable. Um, it's just knowing. Some people are more willing to take some risk, and some people more just want to have very low risk, but just really be operators and operating these buildings. So it all factors into your strategy, knowing who you are and what you want to do, but know that both of those people are making a lot of money in real estate. So it doesn't matter which one you are, and you shouldn't really judge the other person either. Um, what tools do you have at your disposal? A lot of times I ask my clients that are new. I say, what tools do you have? Are you a licensed realtor? So you have access to the MLS. Great. So you're going to be able to help out with um, either if you're yourself or your team locating the properties. Fantastic. Are you a contractor? Fabulous. And then you'll be a huge help as far as being able to help everyone um, figure out what the construction costs are going to be to either fix it up or rehab it, which is a huge component of it. Um, are you a networker? Are you do you work in a business where you're constantly out talking to people, which can be very easily dismissed as a role in your investment team? But if you have someone who is constantly in conversations with high net worth individuals, that's a potential person that can go out and recruit money for you. Say, listen, I have this friend who started investing in real estate, and look at this deal he just did, and hopefully try to pique that person's interest of, oh, okay, well, those look like really good returns. That looks interesting, and try to bring that money to the table. Anytime you can bring private money to the table for either flipping or investing in real estate is a huge bonus. Once you can get to the level where you have a private investor, you're a huge step ahead of being able to make a lot of money in real estate. So if you have someone who can be part of your team that can offer that can casually over drinks talk to someone about, hey, me and my friend are starting this real estate business, and here's what we're doing. What do you guys think about it? What input can you give me? And sort of stoke the fire a little bit. It's a very important role to play, because all of this is for naught if you don't have money to close on the deal. Uh, Obviously, I have something to bring to the table if you're an attorney. Even if you just work in a law office, or if you're paralegal, you still have that knowledge that you can bring, where you can. A lot of times, it doesn't help necessarily finding deals, but what you can do is you can make sure that you don't buy bad deals, which can be incredibly important. At the 11th hour, I try not to kill deals, because real estate attorneys get a bad rap for that sometimes. But sometimes the most important day that you have as a relationship with one of my investor clients, or that you might have with one of your clients, is figuring out that something is horribly wrong with the deal and killing it at the last minute and saying, if you buy this, it's going to be a huge mistake. You need to get out of it right now. Um, it happens sometimes. It doesn't happen all the time, but when you dodge that bullet, it makes a huge deal of you not having to take on losses and continue to build positively without having to take two steps back for buying something you shouldn't have bought. Um, Probably the most extreme example was the condo in a building where we were getting ready to go to closing, and we found out that it had huge structural issues. I mean, and the columns holding up this entire condo building basically were faulty. We're going to have to be replaced. Structural engineer is going to have to go in and like pull the whole building apart and put it back together like Lincoln Logs, because whatever they had done, the building was giving way. Obviously, we wanted nothing to do with that. I mean, that was going to be a huge problem. So Know what your role is. Know who you are. Know what you're bringing to the table, and what tools do you have? What do you have access to people? Do you have access to money? Do you have access to information? Do you have access to the things that you'll need, like the what am I trying to say? You'll have access to the materials that you'll need. You'll have access to the materials you'll need, because some people really provide value by getting you really cheap hardwood floors or getting you really cheap, materials for the property. It's wonderful when you find someone that can get you, quality cabinets for an amazing price. All those things factor in. Every time you save money, it's money in your pocket when you're doing a project like this. Um, are you handy? Do you want to be handy? Some people are not handy but want to learn, because they see it on TV and then quickly find out that they're either not handy enough to do it or they don't want to be handy because it's a lot of work. It's you could do some like cute little fun jobs like putting up a backsplash or something. Um, but once you get halfway through, you know, doing a couple bathrooms yourself, you might say, I don't think I'm cut out for doing this. I think I'm better off in the office. There's nothing wrong with that. Just know your role and know who you are, so you can work on building your team. Um, what was the? I'm trying to read my note here. Find something to build. I don't remember what note that was. That was from some question that someone asked me this morning. Um, you can start from scratch. All right, that was another conversation I had this afternoon. Do you need to be experienced? What level of experience do you need to have in order to get going with this? I was talking to a guy that was relatively new, did some wholesaling. He really wants to get into doing his own investments. Um, what level of experience do you need to have? Real estate's kind of funny where it's easy to learn the basics to get in the door, and it's really hard to learn the advanced things. There's this huge gap between getting in the door and finding out the basic information and then getting to that really high level where you know everything about everything. There's a massive gap. Um, and sometimes you'll get, gurus or fancy people who are basically packaging and selling you the basic information. They're never really going to get into any of the detailed or advanced things. They're basically just taking all the really basic things that you need to know to get in the door, putting a nice shiny bow on it, and making you pay a bunch of money for it. You don't need to do that. You don't need to. Some people offer some nice packages for a reasonable price. If you've ever had someone offer you something where you were going to have to pay like $30,000, you're not going to get anything more than a really fancy and very motivating presentation of the basic information. They're not giving you very advanced stuff. I've looked into these different programs to see what people are doing because people ask me about them, and looking at the information in them, it's just pre-packaging and really fancy bow on the basics. So just know that. But there are some people who offer, paid packages where you're getting, all the basic information, but they're giving you a clean presentation where you can get it all. Do you have to? No. There's tons of sources for free information. You just go on the internet. There's tons of articles you can read. Podcasting is amazing for sourcing information. You can go on the Bigger Pockets podcast, and there's endless information on there that you can learn from other real estate investors. And they have a message board where you can put questions on there. You can search other questions that people have asked and read the responses from other experienced investors and really learn a lot from doing that. There's so many sources where you can get free information. It's going to take a little more work, but if you're willing to put in, when you get home at night, read, listen to podcasts, read. If you're in the car a lot, you could do the podcasting and listen to your car and get all the information that you need. If you're worried that you don't know enough, just make sure that you're surrounded by people who you feel know what they're doing. So have an agent that you feel comfortable with, that they know how to talk to an investor. Have an attorney that you feel comfortable um, has had experience with working with investors and knows what they're doing with real estate. My one little critique I would give with other attorneys is a lot of non real estate attorneys feel that they can do real estate because it's easy, and there's not much to it. It's deceiving. I unfortunately had a conversation the other day with an attorney who just forgot to extend the mortgage contingency, and the deal fell apart. And we're going to take the earnest money because they waited till the day before closing to let us know that the client wasn't going to get their mortgage. So, the mortgage had expired. The mortgage contingency had expired a week and a half ago. So yeah, we're going to keep that earnest money. Um, and it was just he missed it. He just admitted to me. He just said, I completely forgot. I just whiffed it because he practices a different area of law. That's not what he does. So get someone who does real estate. I mean, this is what I do all day, every day. There's a reason for that. It's very nuanced. Again, even from the legal side of it, it's very easy to get into it, but you can get in over your head if you don't know what you're doing. So get someone that knows about real estate or knows how to work with investors when you're picking your attorney. That's just my one little nitpick. Um, Vet your contractors. That's hard. We'll do a whole separate thing on that. Vetting your contractors is there's multi-million dollar investors that still have issues with contractors. So don't feel bad about that. So know that it could take you a while, depending on how much information, what your background is. It could take you a while to learn a lot, but you can still get involved even if you don't know everything. Just trust the people that you choose to work with, that they know what they're doing and that they're guiding you right. Um, Whoever you are, whatever role you're doing, whatever role you want to bring to the table, you can still make money at this. Real estate gives you the ability to um, really make money no matter what role you're going to play in all this. You can make money by being, obviously the contractor, by being the project manager, just saying, I'm going to go there every day, make sure everything looks at the property for you and keep an eye on things. By being the agent, by being the person who raises the money. Um, Everyone can get a piece of it. It's just having a good agreement worked out ahead of time as far as how much money everyone's going to make. Um, Most people, I would say, usually have. I'm going to do a thing on partnerships, but just to give you a snapshot right now, most of the time I would say there's usually two partners and then maybe one or two other team members. By that I mean partners are people who are sharing in equity, and then team members are people who are getting paid not on equity in some other capacity. So like your realtor would be a team member because they're going to get paid on commissions. They're not going to get paid on equity. Um, your investor, if you have a private investor, may be a partner because they may want equity on your deal, or if you have a solid relationship with them, they may just be giving you a mortgage, which really, in my standpoint, I put them as a team member. They're your investor because they're not sharing equity. They're just giving you a mortgage, private mortgage, and a note for a set interest rate. So you really are looking at that as a fixed cost that you're incorporating in, and then whoever else is involved, who's owning the property that's going to share profits, those are the partners that are involved with it. Some people do it all themselves. They're solo as the owner and then treat everyone else as a team member. Everyone else is a fixed cost. The contractor's fixed cost, realtor's fixed cost, my private lender's a fixed cost. And some people like to have multiple people involved. Some people want to partner with their contractor. Some people want to partner with their realtor. And by doing that, what you're doing is you're taking those hard costs and you're kind of pulling it into the equity part of the deal. To make some people want to do it because they want to make sure that they're going to make money on the deal. So by doing that, you're pulling more money back into the pot to make a bigger pot. Everyone ends up getting like a lesser chunk, but you make sure that there's going to be profit at the end of the day by kind of lessening your fixed costs on there, if that makes sense. And I'll come back to that on another day when we're talking about setting up your deals, pitching your deals, and doing your partnerships. Like I said, when you get into more advanced stuff, it takes a while to get this. You're not going to get it in one video. Know what you bring to the table. I had another conversation with someone about that. Know where you're going to have to fill in gaps. That's important. So know where you're going to have to fill in gaps. Look at what team you've established. Get someone that calls me and says, all right, me and my contractor are going to start buying properties together. Okay, well, how are you going to find the properties? Do you have an agent that you're going to have? Knowing where your gaps are, or you just it's me and a contractor, and just we'll find stuff and we're going to buy it. Well, you're not really analyzing the deal then. You're just going to buy, junky houses and put a bunch of work into it. And the danger with that is I don't come across it very often, thankfully, in my practice, but I have encountered people who bought cheap houses, put a bunch of work into it, and then had the intention of flipping it. And then when they got all done, realized that at best they could maybe break even, well, maybe even be losing money on the property. They didn't really put any thought into, that gap that they had, or filling that void in their team building. They didn't have an agent to show them the comps or tell them, okay, this is what it's going to be worth at the end, or this is what it's worth now. This is what you should pay for it. Every once in a while, I get someone, unfortunately, that doesn't do that or didn't put value in that, and way over improves the property, or improved the property where there's no comps in an area, and there's no basis for them to get the price that they're asking for it, which is unfortunate. So know where you have to fill in your gaps. The other big issue we have are people who do a ton of research but just have absolutely no clue how to factor in contractor costs. They have no idea how much it costs to gut a bathroom. They have no idea how much it costs to gut a kitchen. And they try to throw in costs in there, throwing in all the big costs, and they forget all the little things. There's lots of little things that go into successfully rehabbing a house. The devil's in the details. So they a lot of times underbid themselves on it. They just don't realize how much it can cost to redo a property, or they get so excited they way overspend on, say, floors in the beginning, and then or way overspend on custom kitchen cabinets, and then when they're getting down to the final details, there's just they don't have enough money. They've way overspent on it. So know where you need to fill in your gaps, and know that, and work to fix that. Work to close that gap on your team. The name of the game here is being efficient. I talked to a client this morning that was going through analysis paralysis, and I reminded him of that 20-minute rule. You need to be efficient in your deal evaluation. Stop exhausting yourself looking at everything that shows up. This particular client was looking at everything that was showing up on the auction calendar, on the Judicial Sales Corp every day. You can't do that. You're going to drive yourself crazy, especially because when you're working with judicial sales or auctions, you don't even know what the price is. So you're trying to back out with an imaginary price in mind, and none of them may be within what you're willing to pay for it. So you're wasting all of this time and all of this energy on getting nothing. So you need to narrow it down. Don't bid on every auction in the entire Chicagoland area. Pick your pocket and stick with that, and stop driving yourself crazy. So, narrow your view to what deals you actually can do. If you live way on the north side, why are you considering, if you live in Gurnee, why are you considering a deal in Aurora that you're going to flip? You're going to drive yourself crazy. You shouldn't be. It could be a great deal. Let someone that lives in, Naperville or Aurora do that deal. You don't need to drive yourself crazy, exhausting yourself chasing after that deal. At least that's my advice. Because I'm the one that gets the phone calls from the clients that have been in the car for 2 hours in traffic and are ready to pull their hair out, and are wondering why I let them buy this deal, sarcastically, but are wondering why I let them, buy this deal. So keep rethinking your strategy. And when you're and this is another thing, this isn't something for new people. This is for Like I say, I have meetings tomorrow with people who already have been doing this for a while, people who already have a couple properties under their belt. Um, and you want to keep reanalyzing your strategy. What things did we do right? What things did we do wrong? What can we clean up? What can we improve on? We bought this property and I really don't like it. I don't think we should look at properties like this in the future. Um, or maybe I can offer some advice of I think this is why you don't like this property. What things can we tweak? You're always altering your strategy. I really like this pocket. I think there's really good opportunities here. I wanna really focus in on this area hard because I think that there's going to be an economic boom here and the prices are going to go up. So I want to buy everything I can in this pocket as fast as possible. Okay, now we know that going forward. Um, I hate this particular pocket. I never want to buy a property here again. And I'll know that because a lot of times I get stuff sent to me that I might send off to my other clients. I get a lot of wholesalers and off-market things sent to me. Then I will forward off to my clients. Say, hey, here's something that fits within your wheelhouse. Do you think this is something you want to do? I had a couple of those this morning that they're going to get back to me tomorrow on. They should have got back to me today, but they're going to get back to me tomorrow on because they're going to do their deal analysis tonight and let me know what they want to do. So you're going to want to develop your type of property, your pocket area. Know if I had a conversation with someone yesterday about wanting to get into distressed properties. I get asked a lot about auctions. That's why one of my first videos was about auction bidding because it's probably one of the top things I get asked about. Second thing is people just want to know about distressed property. Distressed are properties that have either been abandoned, maybe they just can't find the seller. We get a lot of those in Chicago. I've had a lot lately of properties where people are just out of state and just abandoned a property. It's just sitting there. And then you have to locate the seller and try to convince them to sell and give them a price to make them want to sell. You can have, bank foreclosures, HUD properties, that type of thing. Auction.com, I talked about in the video the other day, which is a great source. So I get a lot of people ask about distressed properties. Just know that when you're dealing with a distressed property, that there's unknown amount of work involved with it. So when you're buying something that's on the market, you can go do your inspection, find out how much work that's involved. If it's too much, you can back out. Just know if you want to get into distressed properties, there's incredible profits you can make there, but there's incredible unknowns with the amount of work that's needed. You can buy a property and find out it needs all new plumbing and electrical that you hadn't factored in. There could be problems with the roof. There could be any number of things. So just know that that you need to have contractor contacts or something along those lines if you're going to start doing distressed properties. If you're scared by doing contractor work or contractors, maybe not distressed properties or a type of property where you can get in and inspect everything. So like a foreclosure that's on the market that you can take a look at it. But some of these deals you have to bid blind, not getting interior access. So you need to know that don't bother with that if that you're freaked out by having a property that needs a lot of work done to it or unknown amount of work to it, or if you don't know how to bid for that. So just avoid those altogether. Just take that off of your plate. I mean, again, by narrowing that search, you're not going to buy a bad property, and you're only going to be considering properties that you can actually purchase and get it done. You don't want to spend days putting work into assessing and evaluating a property that you're probably not going to buy. So don't waste your time with this. Don't put yourself in analysis paralysis. Put yourself in a position of action where you can take action. 20 minutes, look at it and go, this is a great deal. I want to start looking at this. I want to find out how I can buy this one. And again, I had a little note to myself at the end here. You want to be able to make a quick, informed decision. That's really what it all comes down to. The strategy puts you in a position to be able to make a quick, informed decision so you don't miss out on anything. If you find yourself missing out on deals, you might have to revise your strategy a little bit. Part of revising your strategy could just be how you're submitting your offers. If you find yourself consistently missing out on properties, if you've done everything that I said that you need to do, and you're consistently still missing out on properties, you're going, I don't understand what I'm doing wrong. You may not be doing anything wrong. You may need to look at what you're doing to put offers on the property, because you really want to get in there and lock them down. If you're not locking them down and getting them under contract, maybe there's just something wrong with the way you're submitting the offer. Some of the banks and things have very particular instructions that you have to follow to the T, and if you're not following them, then you're not going to get them. HUD's big for that. If you don't follow HUD's rules to the T, you're not going to get the property. Maybe there's something wrong with the pre-approval, or you don't have a pre-approval, or you don't have a proof of funds, or a legit looking proof of funds, that people just don't want to consider you. It also could just be that you're in a really hot area, and if you're putting an offer on a property and you're getting an FHA loan to buy it, and someone else has cash, they're going to take the cash offer every time. And you're going to be in different areas. You're going to be dealing with all cash buyers. So maybe you need to talk to other agents, talk to other people, and find out what offers are coming in on properties that you're bidding on, because it just may be that you're being outgunned by the other people that are bidding against you. You need to know that. You need to know that going in, and figure out some way around that. There's always ways around that. Unfortunately, that could be for your first few deals. You have to take that low-lying fruit. Wholesalers are big for that too. Wholesalers want to offer up the best deals to the people that they know are going to close, that have cash and are ready to close immediately. So if you make a contact with someone, that's great that you made that contact and you've started to establish that relationship, but you may have to take a marginal deal in order to get on their radar that, okay, here's a person that closes deals, because they're really good deals. They're either going to, keep for themselves potentially, or they're going to give to people who they know are going to close immediately, that are ready to close now. You have to show them that. Same thing with agents, especially if you get in the commercial area, if you're looking at doing like a 6-unit or up apartment building, they want to close with people that they know, have money or have the ability to close. They don't want to mess around with, a first-time investor. So that's why sometimes you have to start out with maybe a single-family home to work your way up to show people that you're serious. In the bigger buildings that you get into, they need to see that you have the capability to close. They don't want to waste time with you, because it's a lot of work getting those big commercial deals done. So you need to show them that you have the ability to get it done. So that could be your obstacle. You need to know all those things. And if you have all the right people on your team, they'll be able to tell you that. Just say, listen, I think that you're up against people where you're just getting beat out consistently, and I think we need to redo your strategy to get you properties. It might not be the one that you wanted going in, but we can build you up to the one that you really want, and we'll get there in the end. It's just not going to be, you're not going to walk into a 15-unit apartment building on your first purchase. No one's going to take you serious. You need to work your way up to that, so that people know, or you're going to have to buy the building that maybe everyone else already passed up on, and now you have the opportunity to buy it, and you can try to make it work, whereas the other guys picked off the really, really good buildings. All that falls into play with it. So strategy is not just something that you're going to write it out and it's going to be done and that's it forever. Strategy is something that you're going to continue to craft as a real estate investor, relentlessly. You're always revising your strategy. I would say once a year, at least once a year, you need to sit down, look at what you did, look at what was successful, look at what was not successful, and revise your strategy accordingly going forward. Because it doesn't stay the same. You have to keep changing. The real estate market changes. If you're focused on a particular niche, an area with a particular kind of property, if you're focusing on that, maybe other people are focusing on it, it might dry up. Maybe all the leads are going to dry up. There was 100 leads, and a lot of those leads got bought up by people during the course of a year in this particular area, and now there's only a couple to go around, and a bunch of people are still going after them. It might be time to pull away and go to a different area, or pick a different type of property or do something. You have to keep moving. You have to stay moving in the real estate business because it's always changing. Things are always moving. If I was still only focused on doing short sales like I was, 6 years ago, I'd probably be struggling because there's still short sales, but not that many of them. There's not that many to go around. Um, if I was still focused solely on only doing apartment buildings like I was doing a couple of years ago, I'd be, you know, busy but struggling because a lot of the big apartment buildings got taken up in Chicago. The apartment market got really hot, and now there's a pent up demand, and there's only so many big apartment buildings. They're building more of them because there's still a demand for them. So it's flowing. Right now, I would say that the biggest strategy I've seen, not to give away any of my clients' information, but the biggest strategy I've seen right now is people are really focusing back on rehabbing and renting out single family homes. My long term investors are scaling back and want to do more single family homes just to hold them. Um, not because they necessarily want to, but like I was saying, the apartment landscape has gotten very difficult, and they find it's easier to pick off cheap single family homes and rent them out and get the returns they're looking for than to reach for maybe an overpriced apartment building. Same thing with my short term investors. Are really are ramping up to hopefully do a lot more business this next year on rehabbing and flipping both single family homes, and really what's gotten hot is taking two flats and deconverting them to single family homes. That market's been very hot because a lot of single family homes in certain pockets have been kind of the good opportunities were gone. So a lot of people were looking at two flats as a way of continuing to do single family home work. So that's kind of the trend I'm seeing right now. As far as my strategy meeting so far from yesterday to today, we'll see how tomorrow goes. Maybe I'll do an update and let you guys know if anything changes. But so far, that seems to be the very strong trend for 2019 going forward. Obviously, any apartment building deals that come up, people will go for them. But we're just not seeing a lot of really good ones, unfortunately. At least in Chicago. It depends on where you're watching this video from. So that's it for right now. That's my video on strategy. Hopefully this was helpful for you guys, and got a lot of ideas for more videos. We need to do a video. It sounds like we need to do a video just on team building because there's a lot of things I didn't get to hit on with that. On deal analysis, on backing out. It's all good stuff. All stuff you guys are going to need to know. So it's getting late. I got to go. My wife's wondering where I'm at. Have a good night.